All right, let's talk about something that's become a real minefield for businesses in Turkey: transfer pricing. Simply put, it's all about how you price deals between different parts of your own company. And believe me, getting it wrong can have some pretty serious consequences. So let's just cut to the chase, right? Are you actually prepared for this? Because Turkey's tax authority is zeroing in on this area, and they are not messing around. And that's exactly what this explainer is for. Over the next few minutes, we're going to break down exactly what you need to build a rock-solid defense. We'll cover the essential rules, the must-have documentation, and how you can shift your mindset from seeing this as a burden to seeing it as a real advantage. Okay, so first things first. Why is this suddenly such a big deal in Turkey? The answer is pretty simple. The spotlight is on, and it is bright. Well, it turns out the Turkish Revenue Administration has let's call it a short list of who they're watching. If you're a multinational, if you're in tech, if you're providing services across borders, or if you're dealing with internal financing or licensing, yep, you're on their radar. Why? Because those are the classic areas where profits can get shifted around, and the authorities are laser-focused on clamping down. And this is the aha moment, the big shift in thinking you need to have. Transfer pricing compliance isn't just about filing forms anymore. It has become your primary line of defense. It's the shield that stands between you and a world of audits, penalties, and painful tax adjustments. So, if this is your defensive strategy, what does your arsenal look like? Well, Turkey's basically adopted a four-part system, which is right in line with what we're seeing globally. Let's dig into it. It all boils down to these four key layers of reporting. Think of it like a pyramid of proof. We're going to walk through each one: the master file, the annual report, the country-by-country report, and the transfer pricing form. At the very top, you've got the master file. And that name is perfect, because it really is the master plan, the 30,000-foot view of your entire global operation. It's what gives tax authorities a bird's-eye view of how your whole business fits together. So, do you need one? Well, the numbers are pretty clear-cut. If your group's total assets and your net sales were both over 500 million Turkish lira in the previous year, then yep, a master file is on your to-do list. But here's what's really telling about the master file. It's not just some boring org chart. You've got to lay out your entire value chain, put a spotlight on your intellectual property, and spell out all your internal financial dealings. For a tax authority, this document is basically a treasure map to where you create value and where you record your profits. All right, moving down from that global view, we get to the annual report, or what a lot of people call the local file. And if the master file is the world map, this is the super detailed street map of your Turkish business. Honestly, this is probably the most critical piece of paper you'll put together. And believe me, the devil is in the details here. Your annual report has to dig deep into what your Turkish entity actually does, what assets it uses, and what risks it takes on. You have to back up your pricing methods with solid, defensible benchmarking data. This is your moment to prove that your pricing is fair. Okay, layer number 3 is the country-by-country report, or CBCR. Think of this as a global scorecard. It gives tax authorities a simple, at-a-glance look at where you're making money, where you're paying taxes, and where your people and assets actually are. For them, it's a quick way to spot potential red flags. But you can breathe a little easier here. This one's not for everybody. The CBCR is really reserved for the big multinational players. The magic number to remember is 750 million euros in consolidated group revenue. If your company plays in that league, then this report is absolutely mandatory. And that brings us to the final piece of the puzzle, the transfer pricing form. Now this one's different. It's not some report you keep in a drawer. No, this is a mandatory attachment to your annual corporate tax return. It's basically a public summary of all your dealings with related companies. And right there, that's the number one tripwire. The simple-looking form has to line up perfectly with all that deep, detailed work in your annual report and your master file. Any little mismatch? That's not just a mistake. It's a giant flashing red flag for auditors. So we've covered the what to do. Now let's talk about the what not to do. These are the common mistakes that basically scream "audit me" to the tax authorities. It sounds almost too simple, but the number one error? Just not having the documents ready on time. Missing that deadline, I mean, you've essentially handed them a win before the game even starts. Next up is a story that just doesn't line up. You know, when your transfer pricing form tells one story, but your in-depth reports tell another. To an auditor, that's like smelling smoke. they're going to come looking for the fire, for sure.
And the last one, just having a report isn't enough. A weak, flimsy analysis, maybe a half-hearted benchmarking study is just not gonna cut it. It's like building your defense out of cardboard. It'll fall apart the second someone pokes at it.
You know, this quote from the source material just nails it. Documentation is no longer a formality, it is a defensive tax strategy. It perfectly captures that mindset shift we talked about. This isn't about ticking a box, it's about building a fortress for when, not if, the questions start coming.
Look, I get it. All of this probably sounds like a massive headache. And yeah, it's a lot of work. But what if we flipped the script? What if you could turn this whole compliance nightmare into a real strategic advantage for your business?
I mean, just look at the two paths you can take. On one side, you've got the reactive path, which leads to audits, big penalties, and just endless headaches. But then you've got the proactive path, and that's where you find a rock-solid audit defense, you uncover opportunities to optimize costs, and you get a crystal clear view of your global risks. The choice seems pretty obvious, doesn't it?
So let's just leave you with this one question to think about. Is your business audit ready, or is it just reactive? Because honestly, how you answer that is going to define your success and your stress level in Turkey. Thanks so much for joining us.